Hi, I'm Tom Dalton, and welcome to Tax Boot Camp. This is part 2 in calculating corporate taxable income. In this video, I'm going to focus on a few of the common M1 or book tax differences that you'll see when you're preparing a corporate tax return. So let's jump right in. Let's start with M1 items created by capital losses. And a good place to start is with Schedule D, Form 1120, because it describes the process. For both individuals and corporations, short-term capital gains and losses are first netted against each other. You can see that in Part 1 of the form, where this netting process occurs. Second, long-term capital gains and losses are also netted. You can see that in Part 2, where the netting process occurs. If there is still a mixture of losses and gains, there's a third netting process that occurs in Part 3. So to summarize this, capital losses can only be deducted against capital gains. After that, no more losses can be deducted. Now for individuals, an additional $3,000 of any excess losses can be deductible, but this doesn't apply to corporations. There is no $3,000 amount, and the losses can be carried back 3 years and forward 5 years. Let's take a look at this example, where we have a combination of short-term capital gains and losses and long-term capital gains and losses. We're going to go through the entire netting process. In Part 1, we end up with $60 of short-term capital gains. When we go to Part 2 of the form, we end up with $25 of long-term capital loss. After we go to Part 3, we end up with $35 of short-term capital gain. The book gains are still going to be $35, and the tax return gains are also going to be $35. This means there is zero M1 item for capital gains in this example. In the next example, we're going to end up with $50 of short-term capital loss and $15 of long-term capital gain. Since we have a mixture of gains and losses, we go to Part 3 and end up with a $35 short-term capital loss. So the book loss is going to be a negative $35. However, we cannot deduct losses on the tax return, so we end up with an M1 item, a book tax difference of $35. For tax purposes, this loss can be carried back 3 years and then forward 5 years. After that, it disappears. In the next example, we end up in Part 1 with an $80 short-term capital gain, and in Part 2, a $145 long-term capital gain. Since there are no net losses, everything is reported as a gain on the books, and everything is reported as a gain on the tax return, leaving us with no M1 item at all. Here's another possible M1 item that can occur when you have a shareholder employee who is also a related party because they own more than 50% of the corporation. One of the issues we try and avoid in tax is having the double taxation with C corporations. This is where a corporation has a profit and pays tax on it, and then when they distribute whatever money is left to the shareholder also pays a tax on that distribution as a dividend. Preventing this double tax has long been an objective in tax planning. So how do we do it? One way would be to elect S status, but let's assume here that the corporation cannot or does not want to be an S corporation. They want to remain a C corporation. What other options are there? One common technique, if the shareholder is also an employee, is to pay the owner a salary equal to the profit of the corporation. This will zero out the taxable income of the corporation, and the corporation will not have to pay tax. Of course, the owner will have to pay tax on the salary, in this case $100,000, but at least that's a single tax, not a double tax. Well, if this is legal, and it is, I have a better idea. If the corporation is an accrual corporation, why don't we just accrue the salary expense on the part of the corporation, take the tax deduction, and zero out the taxable income? We don't actually pay the owner $100,000, we just make this journal entry. And if the owner is a cash method taxpayer, they don't report the income and pay tax on it until they actually receive it. This seems to be the best of both worlds. The corporation gets a $100,000 deduction, but the shareholder does not report it as income, at least not yet. We could delay the shareholder reporting the income simply by delaying the payment for years. Unfortunately, Section 267A2 prevents this from happening. It says that if two related parties, and that's what we have here, with different accounting methods, and that's what we have here, then an expense is not recognized until the income is recognized. So in our example, the corporation would be not allowed to take the $100,000 deduction until it paid the shareholder and the shareholder recognized the $100,000 as income. We now have an M1 item of $100,000 and the corporation's taxable income remains at $100,000. At least until the shareholder pays tax on the $100,000 of compensation. In our second example, the shareholder is still a related party to the corporation, owning greater than 50% of the stock. We're going to assume this time there's a sale of property between the two entities. The corporation sells the land to the shareholder for $100,000. The basis to the corporation of the land is $150,000. That gives the corporation a realized loss of $50,000. The corporation, of course, would like to deduct this $50,000 loss on its tax return. Unfortunately, Section 267A1 disallows losses on sales between related parties. Therefore, the book loss of $50,000 cannot be recognized by the corporation. It will remain zero on the tax return, creating an M1 item of $50,000. Here's another M1 item. Officers' life insurance can create a book tax difference. As it turns out, corporations many times like to take out life insurance policies on employees. The corporation will pay for the insurance premium, and the corporation will be the beneficiary if the employee dies and there's a payoff. In this case, the officer's life insurance premiums are deductible on the books, but not for tax. This creates an M1 item. Here are three expenditures that can create M1 items: organizational costs, startup costs, and syndication costs. All three are required to be expensed under generally accepted accounting principles, yet only organizational costs and startup costs are allowed a deduction, and then generally under amortization for any substantial amounts. Organizational costs are generally the costs of creating the shell of the corporation. Generally, they're legal fees and organizing fees just to get the corporation up and running. On the other hand, startup costs are generally costs in getting a business up and running. A good example of a startup cost would be a marketing study to see the feasibility of opening a particular business. Both organizational costs and startup costs are treated the same way for tax, even though they're under two different code sections. The corporation has to elect to amortize the costs over 180 months. However, for the first year of amortization, the corporation is allowed to deduct up to $5,000 of these organizational or startup costs. That $5,000 allowance, though, is reduced by $1 for each dollar of these costs that exceed $50,000. This is done separately for both organizational costs and startup costs. Here's an example of the calculation. Let's assume a corporation incurs $52,000 of either organizational or startup costs, and the business begins on March 1st. That means the calendar year for the first year is only 10 months. The costs exceed the $50,000 threshold by $2,000. Therefore, the $5,000 immediate expense gets reduced by that $2,000, so now it is only $3,000. The remaining $49,000 of costs are still allowed to be amortized over 180 months. So if we do that over 180 months, that turns out to be $272 per month. But remember, this is the first year and it's only 10 months long. So we can only take 10 months of that amortization for a total of $2,720 for the first year. So the total deduction is the $3,000 we have from the immediate expense, the $2,720 from the amortization, or a total of $5,720 for the first year. The annual deduction after the first year goes back to $3,264, the full amortization. There is no tax deduction for syndication costs simply because no specific code section allows it. In fact, Section 167 says that all such costs must be amortized over their useful life, and we cannot identify a useful life for syndication costs. Syndication costs are generally brokerage fees and commissions in an initial public offering of a stock. Such fees are expenses on the books but can never be deducted for tax, thus creating an M1 item. A simple way to remove these expenditures as an M1 item is to simply treat on the books these expenses the same way you treat them for tax. Make an adjusting journal entry, record it on the books, and then you do not have a book tax difference between organizational costs, startup costs, or syndication fees. The financial statements won't be according to GAAP, but then again, if the corporation isn't required to have everything in their financial statements under GAAP, this would work fine for the corporation, and it does for a lot of small corporations. Bad debt expense many times creates an M1 item. Remember what generally accepted accounting principles says about bad debt expense. It's generally a reserve method where, say, accounts receivable are $1,000, some percentage, say 10%, are estimated to be uncollectible, but we don't know who the specific people are that won't pay us. We're making an estimate. This estimate of uncollectible accounts is generally shown as an allowance for doubtful accounts or allowance for bad debts. In this case, it would be $100. Again, we don't know who it is that's not going to pay us. This is an estimate. The journal entry to create this allowance for bad debts would look like this in the first year. The bad debt expense on the books would be $100. Yet we don't know and can't specifically identify who it is that's not going to pay us, so we would have a zero bad debt expense on the tax return. That creates an M1 item. Now let's assume that in the next year, accounts receivable grow to be $1,500. If that's the case, and at 10%, we now estimate the allowance for bad debts to be $150. Yet, we still have, let's say, in the allowance for doubtful accounts, a $100 credit balance. We want it to be $150, so we're going to need a journal entry. The journal entry that will accomplish this is a credit to allowance for bad debts of $50 and a bad debt expense of $50. When we post this journal entry, we're now going to have a balance in the allowance for bad debts of $150. Our bad debt expense for books, though, is $50. Under GAAP, the bad debt expense pretty much turns out to be a plug number that will make the allowance for bad debts work. Bad debt expense for tax is governed by Section 166. What it says is that we must specifically identify who it is that's not going to pay us and provide evidence for that in order to take a tax deduction. In this example, let's say during the second year we identify Joe, Mary, and Juan as not being able to pay us. We're going to have to write off their accounts. It's these specifically identifiable accounts that create our bad debt expense for tax. So our tax bad debt expense is $35. Our GAAP bad debt expense is $50. That gives us a book tax difference of $15, which becomes our M1 item for the corporate tax return. Federal income tax expense is always an M1 item. Section 275 makes it very clear that federal income tax is not an expense on a tax return. There are several common book methods that are used. One is the tax provision under generally accepted accounting principles. That method is fairly complicated, and a lot of companies that don't need audited financial statements don't use it. Instead, they'll use a couple of other methods. One is to accrue the federal tax expense as calculated on the tax return as the book expense. This is the method we used in the example in part 1 of this video. Another one is corporations, typically small corporations, will simply expense what they actually paid in taxes as their tax expense. Whatever the method the corporation is using to record the federal income tax expense, it's non-deductible and the entire amount that's shown on the books as an expense becomes an M1 item. Corporate charitable contributions many times can create a book tax difference in expenses, thus an M1. To explain this one, I would like to go back and use Review Co again. We used Review Co in part 1 to show the process of creating a corporate tax return. Let's take another look at it now and go back and let's find that charitable contribution M1 and explain how it was calculated. That'll explain the process for M1s and charitable contributions. So here we are at the balance sheet. We've got the adjusted trial balance and then a column for M1 adjustments and then taxable income. But of course, balance sheets do not have M1 adjustments. It's income statements that have M1 adjustments. So let's scroll down a little bit and let's take a look at the income statement and take another look at those M1 adjustments on Review Co. First one is the capital losses that were disallowed because they're only deductible to the extent of capital gains. A little bit further, we're going to have the charitable contribution that we're going to discuss this time. It's $27,000 of M1 adjustment. Let's see why. There are some other M1 adjustments, life insurance, entertainment expense, and federal tax expense. And of course, the purpose of all this is to explain why the book income, after all of our adjusting journal entries, is different from our taxable income after all the M1 items. And then what is final taxable income after all the special deductions that are not officially classified as M1 items? So here's what we're trying to find. 10% of taxable income, but taxable income before dividends received deduction or net operating losses, and before charitable contributions. Here's how we're going to find that number for Review Co. We're going to start with the book income after the adjusting journal entries, but before any M1 items. And remember where we found that number. It was over in the adjusted trial balance under income, where there were more revenues than expenses, and we calculated the net income of $478,000. Then we add back the non-deductible federal income tax expense, which again we can find back on the trial balance. And whatever the federal tax expense is, you've got to add it back as an M1 item. Federal income tax expense is never a tax deduction. Now let's add back entertainment expense, life insurance, and the capital loss, because these are also non-deductible M1 items. Finally, we've got to add back whatever is shown on the books as a charitable contribution expense. Here, that's $100,000. For Review Co, that will give us taxable income before the dividends received deduction and before the charitable contribution. We can times that by 10% to get our charitable contribution limitation of $72,000. To go from a book deduction of $100,000 to a tax deduction of $72,000, we need an M1 adjustment of $27,732. There's one other book tax difference I want to talk about that doesn't qualify as an M1 item. That's the dividends received deduction, and it's deducted after line 28, down on line 29, so it doesn't show up as an M1 item. We can see how the dividends received deduction works by looking at page 2 of the tax return under Schedule C. Line 1 shows dividends from corporations that are less than 20% owned. and it's 50%. We can see dividends from companies that are 20% or more owned, and that dividends received deduction is 65%. Then down on line 11, we can see dividends from affiliated group members, and that dividends received deduction is 100%. We can summarize that here. If a corporation receives dividends from a corporation that it owns less than 20% of, the dividends received deduction and the limitation percentage is 50%. If it receives dividends from a corporation that it owns at least 20% but less than 80% of, the dividends received deduction and the limitation is 65%. If a corporation receives dividends from a corporation that it owns 80% or more, it's part of an affiliated group, and the dividends received deduction is 100% and there is no limitation. For the 50% and 65% levels, the dividends received deduction might be limited. It's limited to the limitation percentage times taxable income before the dividends received deduction. So the lower of the two numbers, the potential or tentative dividends received deduction or the limitation, is the one that actually becomes the dividends received deduction. If, however, the corporation is in a loss situation, or if taking the entire full tentative dividends received deduction would create a loss, then the corporation can ignore the dividends received deduction limitation and just take the full deduction. If the corporation is 80% or more owned, it's an affiliated group, and the corporation can just ignore the limitation altogether. So how does it work? Let's say Owner Co. owns less than 20% of Subco and receives a dividend. The dividend is $20,000, so the tentative dividends received deduction is $10,000, 50%. Let's say that Owner Co.'s taxable income is $50,000, which includes the dividend. The limitation on the dividends received deduction is 50% of taxable income, including the dividend, but excluding the dividends received deduction. So 50% times 50,000 is $25,000. That's the limitation. But the tentative dividends received deduction is only $10,000, so it's not limited. In this case, our allowed dividends received deduction is $10,000. Let's do another example, still with less than 20% ownership. Subco pays Owner Co. a $20,000 dividend. The tentative dividends received deduction, again, is $10,000. But this time, let's say that taxable income, including the dividend, is only $18,000. Now, the limitation is $9,000, 50% of $18,000. The limitation is now lower than the tentative dividends received deduction, and only $9,000 is allowed as a dividends received deduction. Note that if we were to take the entire $10,000 dividends received deduction, we would still have $8,000 of taxable income. That's still positive, it's not a loss, so we can't ignore the limitation. We can only ignore the limitation if we have a loss or the dividends received deduction creates a loss. One more example, still at less than 20% ownership. Let's say a dividend of $20,000 is paid to Owner Co. Everything's the same. The tentative dividends received deduction is $10,000. But this time, let's say that the taxable income is only $8,000, which includes the dividend. If we were to deduct the entire dividends received deduction of $10,000, we would now have a loss of $2,000. Because of this, we can ignore the limitation and we're allowed to take the entire $10,000 dividends received deduction. Hi, thanks for watching, and if you liked the video, please feel free to subscribe. I'll see you next time.